2024 edition. And the fourth week of the year has now started. It was a green week. A lot of positive sentiment continues to be out there post OpEx week. So I think it will be an interesting week as we get inch closer to that Fed announcement next week. And that's going to be exciting. But what's even more exciting is we have Luke Guerrero back with us. Luke, how was the snow?
It was a lot heavier than I thought it would be, but I think anytime I leave a ski trip uninjured, it's a positive.
That is a positive. I've seen some videos of you, and let's just say you're a daredevil.
I tend to be. Some would say I am not risk averse.
Not risk averse on the mountain. Maybe in your investment world, but not on the mountain. That's for sure. Well, I'm Justin Klein with Luke Guerrero, and our goal here is to help you navigate the investment world. Luke successfully navigated the, was it Mammoth Mountain? You're in Mammoth, right?
Mammoth Mountain, that's correct.
There you go. And our goal is to help you just unpack everything that is happening in the market today and try to apply some lessons, help you apply some lessons to your own personal financial situation. And we do that by answering your finance and investment questions with our unbiased perspective, developed with over 20 plus years of investment experience. Now, we're going to run down the market performance for today as well as the show topics, but we're going to hit our first caller question now.
I have a question about Eastman Chemical Company, EMN. Was wondering if this is a good entry. Looking forward to hearing your answer. Thank you so much for what you guys do. Have a great day.
All right, looking at Eastman Chemical Company, we actually own this for some of our managed accounts. So we obviously like it. Earnings this year are expected to go up 23% after a bit of a dip last year. And they have a solid balance sheet, good long-term profitability. Right now, we have return on equity right around 11%, but longer-term averages are typically closer to the 20% level. So we like that. Free cash flow right now at about $520 million. Enterprise value to EBITDA looking forward is only about 8 times and a nice 3.7% dividend yield. So, you know, it's in a space where we're reaccelerating. We had a lot of the chemical companies make a ton of money in 2020, especially 2021, when everybody and their mother were buying products, because they didn't go out and spend, because a lot of things were limited and shut down. And so that boosted a lot of the chemical companies' earnings, like Eastman. They made $8.85 in 2021, and that's been slowing since. But now you're, like I said, getting a reacceleration up 23% in expected earnings this year. So we still like it, Luke. Anything to add there?
No, I think you nailed it there. They've had some consistent profitability, some consistent cash flows. They've had quite the run up over the past 4 months, but there's a reason why we hold it for some of our managed accounts, and I like it.
Yeah, and the relative strength about 68, so it's not the strongest performer out there, but definitely in the upper, top, near the top quartile. So we really like Eastman Chemical. Now, we have a lot of ground to cover over the next 40 minutes or so, and our main focus point concerns this topic about mean reversion. And I think this is a good topic to go over because it's really going to help you understand why chasing performance over a 3 to 5 year period is typically not the best way to go. Now, it doesn't always have to mean revert, but basically what it's saying is the performance of any particular asset class over the past 3 to 5 years is probably going to be unlike the next 3 to 5 years. So we're going to dig into the details there. Also, the market is back at new highs. And what does that mean? We're in bull market territory. And what is the expected return or the average return of the market 12 months past a new high in the last 12 months, right? So where you haven't had a high in 12 months and then at least 12 months and then you hit a new high. what does that tell us about the market that we are in? Also, the consumer defaults are rising, but the devil's in the details. So we'll get into the details there as well. And then lastly, there's a lot of people chasing high yield savings accounts, but not everybody actually gets the listed rate. So we're going to dig into that story as well. We also have some voice bank questions. One is in regards to internal rate of return, as well as ICE, Intercontinental Exchange. And we also have a perspective segment that concerns the new Department of Labor classification that could disrupt the U.S. gig economy. Now, Luke, let's talk about the market performance today. We closed last week at new, fresh all-time highs in the S&P, and we followed through today with some strength. Now, interesting enough, remember the S&P is large caps. Today, large caps were kind of meager. They had a meager day. Small caps definitely outperformed, up a 1.4% on the day. Anything else you see on that front?
No, I think that's the big thing to note is the power of small caps today in boosting the market overall. I just think there wasn't really much in terms of news today. Towards the end of last week, you saw a shift in the opinion of when the first rate cut would be. So now the market opinion is that March will not be the first rate cut. Just barely, which is just interesting to note in that now given that we've been making some new highs over the past two trading sessions, there doesn't seem to be any shift in that given the market perception about rate cuts in March. But I think you mentioned at the top of the show, overall, we're just going to await and see the next Fed meeting and what that brings us for the rest of Q1.
Yeah, throughout the first few weeks of this year, you've definitely seen economic data come in plenty healthy. You've had initial jobless claims now below 200,000, and it's not my favorite number to look at. I like to look at continuous claims, and that's been improving as well. It was approaching 2 million, and now it's in a downtrend. So pretty interesting to see that those that are unemployed are getting jobs, getting hired. And so I think those are better numbers to look at. And so the fact that the consumer remains relatively healthy. The job market remains relatively healthy. Yes, inflation's coming down, but until you see even a little bit of crack in the labor market, I don't think the Fed has much impetus to cut. And so I think that as we said going into this year, the market kind of got ahead of itself in pricing in those rate cuts, and now that's starting to price out those rate cuts a little bit, and the higher equity markets certainly play into that as well. Now, I do think now that we're past OPEX and Q1 OPEX, there certainly could be a shift in that trend between growth and value, large cap and small cap. And today, I think you saw the beginnings of that. Now we're heading into a break. I'm ready to take your calls now at 888-99-CHART.
Every investor is working to build a secure financial future.
Would this be an opportune time to get into annuities?
Everyone's situation is different.
Get your thoughts on CRM, Salesforce.
And so are their questions.
And I was just calling for your assessment of Blackstone Incorporated.
To get your take on QE.
Ticker symbol LECO.
Just wanted to get your opinion on JP Morgan.
InvestTalk hosts Justin Klein.
I'm okay paying a fair price for a very good business.
Steve Peasley.
It's a very well-run company.
And now Luke Guerrero.
EBITDA growth is significantly higher than its competitors.
Are ready to provide their unbiased answers. Each podcast is unique, and you set the agenda.
I will.
Hey, hi, Steve.
24/7, rain or shine, InvestTalk is made better by the power of you. Call 888-99-CHART. Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Hello, dear Justin and Luke. First of all, this is Paulo from Gaithersburg, Maryland, calling. All my prayers and best wishes go to Steve and his family and his friends. I learned a lot from his wisdoms, and I hope to hear him again, sound and well. I have a question for you guys. On a stock tracking platform, I can analyze my performance of my portfolio, and it shows me the internal rate of return for the portfolio, which was excellent compared to the nominal performance last year. So I'm not so sure if I understand this measurement right. So could you please explain this indicator and if it's a good measure to track one's portfolio's performance? I appreciate all the work you guys do and all the good work you do, and I'm looking forward to hearing the answer on the podcast. Thank you. Bye-bye.
Well, thank you for the question, and I know that it means, and Justin can attest to this as well, a lot to Steve to hear from all you listeners out there in this time. So in terms of internal rate of return, generally speaking, internal rate of return can be thought of as the annualized effective compound rate that can be expected for an investment or a project. So I think primarily IRR is used in when you look at private equity investments or capital budgeting, and it tells you what is that rate of return required to essentially get you positive net present value out of a project. I'm not sure, given what I don't really know what platform you're using, how they specifically use IRR or internal rate of return, but generally it's going to be the effective compound rate of that portfolio. Do you have anything to add there, Justin?
Yeah, what's probably trying to give you a better sense of is what your returns are when you account for cash flows. Are you putting money in? Are you taking money out? And that's usually what these platforms tend to use IRR for, because those cash flows can kind of skew the overall returns when you do have cash flows in and out. And that can mean for somebody who's, sounds like this caller was younger, maybe he's putting money in regularly, and what that does to that total return calculation or IRR calculation. For somebody in retirement years, it might be taking money out. And that's important to understand as well. So good thing they're using IRR. I think it's a good measurement for that. But each platform kind of has its own idiosyncrasies on how they handle the return calculations. But IRR is kind of industry standard there. All right. Thanks for the call. Now let's squeeze in another caller question from 888-99-CHART.
Hello, would love to get your opinion on AutoZone. The ticker symbol is AZO. I would like to get your opinion on the valuation and how future growth of electric vehicles will affect the stock. Thank you.
All right, looking at AutoZone, AZO is the symbol. And this is one of those names where people get sticker shock. It's currently trading at $2,771 per share at the close. And that sounds expensive, but if you look at it based on earnings this year, expected to be $165.83, it's not nearly as expensive as that looks, about a 18 times multiple, which for a company this consistent and this strong, I don't necessarily think that is out of line. I wouldn't say it's cheap, but it's not expensive either. What do you think, Luke? And do you think EVs are going to have a large impact here?
Well, I think that primarily AutoZone gets its money from distribution of automotive replacement parts, right? And I think over the past 15 years, there's certainly been a lot of advancements that have prolonged vehicles. And certainly for the inconvenience factor, if you will, in terms of driving an electric vehicle, which may force consumers to not want to purchase a new car 10 years from now, for example, when there may be some mandates in your state that a new car has to be an EV. To me, that would seem like there would be more business opportunities for AutoZone to maintain those older vehicles that consumers may want to hold on to. So I think given the EV framework over the next 15 years, this actually may be a benefit for AutoZone.
Yeah, I think long term, you're right. I think short term, there may be some issues because one of the reasons why I've earned a lot of money recently is because the value of used cars was so high. It was so expensive to get it to replace your car. Now those used car prices are coming down along with traditional new cars, and so I think there could be headwind in the near term. But it's a good business at a fair price right now. Now we're heading to a break, so give us a call now at 888-99-CHART.
Every investor is working to build a secure financial future. How they get there and when they get there, that depends on many variables. The more you learn about how the market works, the better your chances. So don't forget to call InvestTalk, 888-99-CHART.
Hi, Justin, Luke, this is Roger from the Bay Area. Long-time listener of the show. Thanks for everything that you do for listeners. I was looking at two stocks, Intercontinental Exchange, ticker symbol ICE, and NASDAQ, ticker symbol NDAQ. Wanted to know your opinion on the long-term prospects of these. And if you had to pick one of these, which one would that be? We'll be looking out for the answer on the show. Thank you.
All right, looking at two pretty similar names, non-bank financials that are in the exchange business, Intercontinental Exchange as well as the NASDAQ. Luke, I'm seeing that the ICE, Intercontinental Exchange, has much better growth and trading at a little bit higher multiple. But to me, it seems like that growth is worth it compared to the NASDAQ. What are your thoughts between the two? Similar names, obviously, right?
Yeah, I would tend to agree. I think that the price to book value, at least from that perspective, ICE actually is trading at a lower multiple, and it's trading at a lower multiple with better margins. I think that this also hints at the theme that I think we've talked about on the show before, especially in the wake of the regional banking crisis, which is a great way to invest in the financial sector is to invest in the backbone of the financial sector, these exchanges being great prospects. So I think if it were up to me, I would probably choose ICE between NDAQ. I like that one more.
I agree. Even though NASDAQ is a little bit better dividend, the strength of the business in ICE looks a bit better. Now we fixed our technical difficulties, but we are heading into a quick break. So give us a call now at 888-99-CHART.
Your objective is to work hard, plan well, and achieve financial freedom, right? You're in luck because Justin Klein is here now, ready to take your finance and investment questions. Call 888-99-CHART.
Now, our main focus point today concerns this topic about mean reversion and how that interplays with asset class performance. And we know that investors like to jump on trends, and many extrapolate what has happened over the past 3 to 5 years, and they think that's what the next 3 to 5 years will be. But the numbers tell a different story, and I really love this data set here because what it talks about is going back to 2019 and looking at the previous 5 years performance compared to the last 40 years performance. And basically saying when that asset class is underperforming over the past 5 years compared to its 10, 20, 30, 40 year average performance numbers, it's likely going to mean revert. And then if you look 4 years on, so 4 years post the end of 2019, you're getting a picture that tells you a lot about how these things can tend to mean revert. Now, asset classes like large cap value, small cap value, small caps in general, they all pretty much mean reverted, meaning that going into 2019, a lot of them had pretty subpar 5-year annualized performance rates, anywhere from slightly negative to about 5%. And then you look at the last 4 years, and what you can see is pretty much all of them have outperformed their past 5 years. For example, small cap value was up 2.6% annualized going into at the end of 2019, and it's gone up 13% annualized since then. Small caps in general were up 5, and now it's up over 10. And pretty much all the other asset classes, from gold to master limited partnerships, that was a big one. It was down 8.6% annualized going into 2019 or 2020, excuse me. And now it has been up over 20% over the last 4 years as we close this year. Gold, same thing. It was about flat the 5 years through 2019. And the last 4 years is up about 8% annualized. So, Luke, what can investors take from this data set in your mind?
Yeah, I think, the first thing that strikes me is I think Warren Buffett said it, that in the short term, the market's a voting machine. In the long term, it's a weighing machine. Mm-hmm. And I think that rings true with the concept of mean reversion. You can have short stints of underperformance, outperformance, but the fundamentals that drive historical returns of different types of asset classes still remain true. Mm-hmm. And so mean reversion is a good way to see that, okay, if these asset classes underperformed in the short term, maybe now is a good time, given their relative valuation to the overall market, for me to try and allocate a little bit more there, and vice versa with outperformance.
Yeah, having that long-term perspective of the returns of various asset classes is extremely important. Because, as you said, Luke, there are certain drivers, and there are characteristics of those companies within the asset class, or the general long-term correlation to certain things, like, what is gold's long-term correlation? That's typically to the underlying currency that you index that to, as well as a certain level of mining growth that tends to happen over long periods of time. So, it's very important to have that perspective, because so many people, I see this a lot when someone has a 401k. How many people that don't know much about markets, they get a 401k, you get a list of ticker symbols, mutual funds that those employees can buy, and they look which did the best over the last 3, 5, 10 years, and they just pick the highest yielding ones. And could that work? Yeah, could, but the odds are typically against that actually being the best way to invest. But the average worker is good at what they do. They're good at their particular skill set they were trained on, whether that's marketing, whether that's sales, whether that's whatever, engineering, whatever it is, it's very different than investing. And so that's the standard human nature, is to chase those returns, not just over a 1 year time frame, which we talked many times about how that tends to be a very, very poor way of looking at what's going to perform in the following year. But even over a 3 to 5 year time frame, that mean reversion does tend to happen. Now, in this case, the only area that didn't have a major mean reversion was actually large cap stocks and large cap growth. Those actually outperformed over the last 4 years their performance of the previous 5, as well as the previous 20 years. So, yeah, but even the 20-year number, you can actually look at this. Going into 2019, large cap growth was only up 6%. Why? Because you actually look at where valuations were in 99, and it shows you how poorly they returned. And when you buy things at very, very high prices, then that mean reversion can happen the other way as well. And you still see that today, where valuations remain fairly rich for those large cap names, even though they didn't have that mean reversion over the past 4 years. Now let's pivot back to the InvestTalk voice bank for a call that came in earlier on 888-99-CHART.
Hi, Steve and Justin. I was wondering, with a Roth IRA or a regular IRA, if you buy MLPs, do you still have to deal with K1s? Or do K1s not apply if it's in an IRA tax deferred account? Thanks so much for answering my question.
Yes, this is a very important aspect to understand when you're investing in master limited partnerships, is that in tax deferred accounts, if you earn, I believe it's over $1,000 in income in any given year, you actually have to file a separate tax return. It's not fun. There are complications with it. Let's just say that. So you do not want to really own K1s. Any partnership And there are more than just limited partnerships that are out there traded in the marketplace, or master limited partnerships. There are other types of partnerships too. So anything that gets a K1, you want to avoid having in any tax deferred account like an IRA or a Roth IRA. Now, if you can stay below those distribution limits, then maybe it's okay if your account's small enough. But generally, you want to stay away from that. I believe it's $1,000 a year. Don't quote me on that. I have to do your own research on that. But I last time I checked, yeah, anything above $1,000 is subject to tax, even if the securities are held in a retirement account. There you go. Yeah, just found it. So very important to consider when buying MLPs. Now, Luke, let's talk a bit about the fact that the market hit an all-time high. The S&P did on Friday, up about 35% since the bottom in October of 2022. Sentiment was really, really bad back then. I remember that, talking to listeners, and nobody wanted to get exposure to equities. And that was obviously a bad move, because since then, inflation has continued to ebb, and the Fed has since pivoted dovishly. And if you go back in history, this is not unusual. Bull markets are 85% of market history over the last 73 years, since 1950. And in times where you set a new all-time high for the first time in over 1 year, the average forward-looking return over the next 12 months is 13.9% compared to the average S&P 500 return of only 7.5% since 1928. So is this telling us that people should be more excited to be in the market than bearish?
Maybe. In short, if you look at I, as you know, have a problem with looking at market performance as the performance of the S&P 500, and here's why. The index that generally will tell you about the health of an economy, health of the U.S. economy, is really how well small caps are doing. And small caps, the Russell 2000 is not anywhere near an all-time high. The S&P 500 equal weight index is slightly below its all-time high, about 10 points below its all-time high. So not to diminish the rally that we've had over the past several months, a couple quarters, but I think that we can't get ahead of ourselves, and that this rally, until it widens out, which I do expect it to do this year, until it widens out, there are some idiosyncratic risks within the market because it's being floated by one theme amongst so few companies.
Yeah, you're talking about the Mag 7, and that's certainly been driving most of the returns. Now, the positive when it comes to your discussion about the market widening out, that has widened out since the recent bottom in the fall, this last fall, and small caps have been outperforming. But this year, they're underperforming a little bit. But this trend is still higher in small caps compared to large caps. So small caps are continuing to outperform since that recent market bottom. So I think that's something of note. And today, small caps, as we discussed, did outperform. But if you do go look at, say, the Russell 3000, that has not made new highs, as well as the NYSE, which is a widely followed index, about 2,500 names. That also has not hit new highs. Those highs were back in the beginning of 2022. So both of those indices, I think, would need some confirmation of the S&P making new highs. And I think I do think you still have to be generally bullish. Doesn't mean you have to be bullish on the same names that drove us here. And it could be just widening out of those names that are starting to outperform. Small caps, industrial starting to outperform, financial starting to outperform. So that'll be interesting to watch as we go through this earnings season. We still have a lot of those I think every one of those Mag 7 names still having to report earnings, and that will have a large impact on not just what the market sees for those total earnings for 2023, but also their projections for earnings in 2024. Now let's play another question from the InvestTalk listener line. And this one coming from Nebraska, and he wants to talk about home builders.
Hi, Justin. This is Nick out in Nebraska. I was looking at some home builder companies, and it seems to me that, even though they've run up quite a bit lately, they seem really cheap as far as the PE and the forward PE. And I was wondering if you could explain that. They seem to be anywhere from about 8 to 10 forward PE. To me, that just seems so cheap. Any thoughts you can give are much appreciated. Thank you. Bye-bye.
Well, their earnings have moved up pretty dramatically. I'll just use Pulte. It's one of the largest home builders out there, 42 markets in 24 different states, about a $24 billion market cap. And earnings pre-pandemic were at $3.63. And this year, they're supposed to make $11.44. That's down 1% from expected earnings for last year. And revenue growth has slowed from the mid-teens to about 3%. So I think what you're seeing here is a slowing of earnings. The housing market affordability continues to be stretched in many areas, but people still have jobs, and supply of homes generally are relatively low, and they tend to be the marginal supplier of new homes, and they're still able to charge fairly high prices because there aren't a lot of options for those that still do want to buy, that have jobs, that have a down payment. They haven't gone away completely. They're just a lot less than they were a couple of years ago. And so with the mortgage lockdown situation, people handcuffed to their 3% mortgage rates, there just isn't a lot of existing supply out there. So the technicals look fine. I look at like the ITB, which is the iShares US Home Construction ETF. That's the best kind of general proxy for the home builders. And that's been consolidating and actually at new highs today. So I don't know, Luke, do you think that despite the run that it's worth picking them up at these relatively cheap prices based on today's earnings?
Yeah, I mean, it is relatively cheap. I will point out, though, that Pulte Group is trading at a 9.2 price to earnings on a next 12 months basis. Its 5-year average is 7.4. It's not too overly valued, but like many things, I think that this sector specifically is very tied to the health of the economy. And so long as the overall economy and the labor market stays tight enough that people have disposable incomes and people are looking to buy homes, especially coming into a rate cutting cycle, this could be a good opportunity to pick up some of these home builders who could have some room to run.
Yeah, I don't see them reversing anytime soon. As you said, they're going to be tied to the overall economy. If the housing market, if the jobs market does weaken, that could start to break some of these names, because if people have more fear of them losing jobs, they're not going to go out there and buy a home. And so you might have that next stair step down in home demand with high prices, with high mortgage rates. And then the third pillar is that jobs market. And if that falls as well, that could really hurt these names. So they're just very cyclical. So they do tend to trade at low P ratios. So don't expect them to trade at a 20 times multiple. That's just not the way these things trade. Now, in the next Invest Talk, we'll discuss this topic. With a 529 plan, you have investment options, and we'll discuss how to take advantage of them for higher education costs. That story tomorrow, but for now, I'm Justin Klein with Luke Guerrero, and we're ready to take your calls at 888-99-CHART. Looking at Equinix. How you doing, Bill?
Yeah, not too bad, thank you. Good to hear you guys again. And
appreciate it.
Yeah, I held this company. I had a couple during the 2022 when it was low 600s, and I just sold it recently at like 812. I kind of like the company. I wanted to take some little gains, and I thought maybe we'll get a break and the pullback. This doesn't seem like a super hot stock, but I like it in general. I like the category it's in, and they do pay a fairly decent dividend. But I wonder, can you analyze their financials? Give me a little perspective on that and what you think of it overall.
Well, for everyone else out there, Equinix is a REIT, a data center REIT, and they operate 248 data centers in 71 markets. About 46% of revenue comes from the Americas, 32% in Europe. the Middle East and Africa, and 22% in the Asian region. And they're one of the largest out there, $75 billion market cap, 2.1% dividend yield. But remember, this is a REIT, so that's taxable at your ordinary income tax rate if it's in a taxable account. So, not an amazing yield there, but it's a good performer. Funds from operation back in 2016 was $15.15. This year expected to be $34.45, and it's pretty much increased it every single year. So I like that consistent performance, Luke. What are you seeing on the valuation side?
Yeah, well, I'm seeing, certainly going back to the balance sheet, they have a good amount of cash on hand, about $2 billion at the end of 2022. I'm not sure what they have at the end of the last year, but given their debt load, I mean, their cash flow can handle that pretty well as well. And, their properties are pretty well diversified. I'm seeing them in a lot of major cities within the U.S. and around the world as well. I think overall, it's, like you said, a very well-run company, a good performer, and I like the segment that it's in within the REIT space.
Yeah, I wouldn't say it's cheap. That's for sure. You're talking about 25 times, roughly, forward-looking earnings or funds from operation. That's a bit rich for my blood. If you look at its history, price-sales ratio right now is about 9.4. That's pretty high. Over the last decade or so, that tends to be closer to 7. So I think that's a bit expensive on that front. So it's one of those names that you want to have on your watch list to buy. But after this recent run up from a low in the fall of around $680, now it's at around $802. I think it's a bit rich, to be honest with you. So I wouldn't be in a big hurry to pick it up at these prices, but I like that it's on your watch list. Thanks for the call. Now, lastly, let's talk about the consumer, Luke. And by a lot of different measures, the default rates from consumers are rising. But what's interesting here, if you dig into the details of companies like Ally Financial and their earnings report, they talk a lot about how a lot of the defaults are coming from those consumers that didn't have access to credit before. And then once there was so much government stimulus and there was a lot of forbearance on loans, and it allowed the measures of credit worthiness for a lot of people improve. And what that did was it allowed them to access more credit, and now they're defaulting on it. So the question was this bad lending practices that were overlooking kind of one-time idiosyncrasies of stimuli as well as forbearance on other types of loans? Or is this the start of a broader credit crisis among consumers?
Yeah, it doesn't seem to be, as of right now, the start of a broader credit crisis. Some might call this a mean reversion in and of itself, and that some people that were uncredit worthy before the pandemic were able to shore up their finances, get some credit, and are now uncredit worthy again. But I don't think at this point, it certainly may say things about the earnings potential of the company of specific companies, but the broader consumer doesn't seem to be in much of a worse spot than it was before the pandemic.
Yeah, and that's what the big banks are saying. And they have a pretty strong insight into how consumers are feeling, how they're spending, and what their balance sheet looks like. Now, I'm Justin Klein with Luke Carrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein.